In this video, I am going to discuss about profitability ratios. Profitability ratios measure how profitable was the business in the short term, typically for 1 year. If any ratio is based on the profitability, it will be a short-term performance measurement because profitability will be typically calculated for a year. Higher the profitability ratios for a business, better the financial performance of that business. These are the most common profitability ratios: gross profit margin, operating profit margin, net profit margin, return on capital employed, return on equity. First of all, let's get to know about the statement of profit and loss. The first line is the sales revenue. This is equal to selling price per unit multiplied by sales units. And then we have to deduct the cost of sales. This includes opening inventory, production cost and closing inventory. The total of these three components will be here. This is the final cost of sales value. What we do is we deduct the cost of sales value from the sales revenue. So we can calculate the gross profit. Then we can deduct the operating expenses. So we can arrive at the operating profit. This is also known as the profit before interest and tax, PBIT. This is because this is the profit value before the interest and the tax is paid. Then we can deduct the interest cost. So we can arrive at the profit before tax. This is also known as the profit after interest before tax. And then we can deduct the tax. So finally we can arrive at the net profit value. You have to have the ability to calculate the net profit and other profit values starting from the sales revenue from this side. And you have to have the ability to calculate the profit figures using the backward calculation as well. Now let's discuss about gross profit margin, GPM. Gross profit margin is the ratio between gross profit and the sales revenue for a specific period of time. Gross profit margin is a percentage value. The higher the gross profit margin, the better a company is performing in terms of profitability. We can calculate the gross profit margin by dividing the gross profit by the sales revenue and then multiply it by the 100%. As now you know, gross profit is equal to sales revenue minus the cost of sales. Sales revenue is equal to selling price per unit multiplied by the sales units. Now let's calculate the gross profit margin for this example. Gross profit margin is equal to gross profit divided by the sales revenue. So what is the gross profit here? Gross profit is 198,000 divided by the sales revenue, which is 250,000 multiplied by 100%. So the gross profit margin for this example is equal to 79.2%. Now let's discuss about the operating profit margin, OPM. Operating profit margin is the ratio between operating profit and the sales revenue for a specific period of time. Operating profit margin is a percentage value. The higher the operating profit margin, the better a company is performing in terms of profitability. This is how we can calculate the operating profit margin. Operating profit divided by the sales revenue, then multiplied by 100%. Operating profit is equal to sales revenue minus cost of sales minus operating expenses. As now you know, this section here is the gross profit. So the operating profit is also equal to gross profit minus operating expenses. Sales revenue is the same, selling price per unit multiplied by the sales units. Now let's calculate the operating profit margin for this example, which is equal to operating profit divided by the sales revenue. So what is the operating profit? Operating profit is this. This is also known as the profit before interest and tax, 113,000 divided by the sales revenue, 250,000 multiplied by 100%. So the operating profit margin for this example is equal to 45.2%. Now let's calculate the net profit margin, NPM. Net profit margin is the ratio between net profit and the sales revenue for a specific period of time. Net profit margin is a percentage value. The higher the net profit margin, the better a company is performing in terms of profitability. This is how we can calculate the net profit margin. Net profit divided by sales revenue multiplied by 100%. Net profit is equal to sales revenue minus cost of sales minus operating expenses minus interest cost and tax. Sales revenue is equal to selling price per unit multiplied by sales units. Now let's calculate the net profit margin for this example, which is equal to net profit divided by sales revenue. This is the net profit, 85,000, divided by sales revenue, which is 250,000, multiplied by 100%. So the net profit margin for this example is equal to 34%. Now let's discuss about the return on capital employed, ROCE. Return on capital employed measures the efficiency of a company's use of capital in generating profits. In other words, it indicates the amount of profit a company generates in relation to the amount of capital invested. Return on capital employed is a useful tool for shareholders and investors as it provides a quick and simple way to assess the profitability and efficiency of a company. A high return on capital employed indicates that a company is generating good returns on its capital investments, while a low return on capital employed suggests that the company may be underperforming or mismanaging its capital. This is the equation we can use to calculate the return on capital employed, which is equal to profit before interest and tax divided by the capital employed multiplied by 100%. Now you know how to calculate the profit before interest and tax, which is also equal to the operating profit. Operating profit is equal to gross profit minus operating expenses. Or we can calculate backward, net profit plus interest plus tax. Capital employed is equal to equity plus long-term debt. Equity is equal to share capital plus retained earnings. So, capital employed is equal to share capital plus retained earnings plus long-term debt. This is also equal to total assets minus current liabilities. If the question is giving you figures for 2 years, you have to calculate the average value. Now let's do this example. We have to calculate the return on capital employed, which is equal to profit before interest and tax divided by capital employed multiplied by 100%. What is the profit before interest and tax figure, which is this 113,000. What is the capital employed amount? It is equal to share capital plus retained earnings plus long-term loan. So the return on capital employed for this example is equal to 11.09%. Now let's discuss about the return on equity, ROCE. Return on equity is a measure of the efficiency with which a company is using the investment made by its shareholders to generate profits. The higher the return on equity, the better a company is performing in terms of profitability. This is the equation we can use to calculate the return on equity, which is equal to profit after interest and before tax divided by equity multiplied by 100%. Now you know how to calculate the profit after interest and before tax. This is equal to operating profit minus interest. Or we can calculate this figure backward, which is net profit plus tax. This is also equal to gross profit minus operating expenses minus interest. Equity is equal to share capital plus retained earnings. Retained earnings are also known as the retained profit. Now let's calculate the return on equity for this example, which is equal to profit after interest and before tax divided by the equity multiplied by 100%. Profit after interest before tax, which is this value. This is also known as the profit before tax. which is equal to 103,000. Equity is equal to share capital plus retained earnings. We do not need the long-term debt value because we are calculating the return on equity. So the return on equity for this example is equal to 11.85%. Thank you for watching. See you in the next video.